Welcome to this episode of the bizval podcast, another international show. The guest on this show is Jeff Erickson, and he runs the partnership side of Forecastr. And he has done a lot of really cool stuff, and I'm very excited to engage with him and actually learn all about that business. But Jeff, also all about the angel investing you've done. I mean, it's a pretty impressive story. So welcome to the show, and thank you for making time for this all the way from Salt Lake City in Utah.
Yeah, thanks for having me. Looking forward to it.
So Jeff, I had a look at your LinkedIn, and it looks like sports are a pretty big part of your life. So obviously I'm in South Africa, and we basically live, breathe, and eat sport. I'm sure you may not even know what the Rugby World Cup is. Stop me if you do. But South Africa's just become the world champions, which is very exciting for us. I mean, does that news make its way to the US at all? Probably not.
Congratulations. That's awesome. That's actually the first time I've heard it. But
there we go. I knew
I
it.
know there are rugby fans here in the US. It's just not something that I grew up with.
Okay. Yeah, I mean, it's the closest you'd have is obviously NFL.
Yes.
Which is your pick of the US sports? Is it NFL? I think that was your LinkedIn profile pick, if I'm not wrong.
Everybody loves the NFL. It's gaining popularity more and more, it seems like. But I love college football. That's probably my favorite. We cheer for the University of Utah, the Runnin' Utes out here in Salt Lake City. And we just had ESPN College Game Day out here last week. And so my family and I, we were able to go to that, which was really fun.
Sounds fantastic. It's amazing how sport is just something that humans just love across the world, even if the sport is different.
Yeah.
So I guess that brings me to my first question, which is, do you think there are any useful overlaps between business strategy and sport? Because I've always felt that a lot of the things you learn on the field and a lot of the ways that a team is managed, there's a lot of overlap with how business is run. But I'm very keen to get your thoughts on this.
Oh, for sure. And if you look at it the bottom level of players and how that translates into whether it's investing or entrepreneurship, athletes in general seem to make great entrepreneurs. One, because you've got to have this grit. As an athlete, you have this mentality that is grit, setting goals, going for it, and big goals. And so athletes can make great entrepreneurs in that sense. I think the other thing that you see is that, especially when you come to professional sports, athletes tend to have the money to invest, as whether they're angel investors or to participate in funds. But the other cool thing is that especially if they're kind of have that celebrity behind them, they can make a difference for the companies that they invest in. So I think you're actually seeing a lot more celebrities or celebrity athletes getting into investing because they can have an impact on the companies that they invest in. So that's one way I think that you see sports and at least the startup world kind of converging there.
Yeah, that makes a lot of sense. And obviously, most sports, you have a relatively short career. I think something like golf is probably one of the few exceptions. So it makes sense, when your body is tired or too old, it's time to go and do something else. I think for me, the overlap is also just in general, the way a team is managed, the strategy behind it. It depends on the sport, obviously. I don't know a lot about NFL, but I think I know enough that there's a lot of strategy that goes into that. I mean, it's basically chess, but with humans. Rugby is very similar. So I think there's a good overlap there with how businesses are put together and run, the role that the coach plays, the sort of architecture behind the thing. It's quite interesting overlap.
Well, not only that, but I mean, the business of sports is definitely a business.
That too.
I mean, if you look at college football, we were just talking about college, American football. There's one conference in particular that basically disintegrated this past year because of different sponsorship rights and the TV broadcasting rights and things like that. So the whole business behind sports is a big deal, and you do have to kind of run sports teams at a certain level like a business.
Absolutely. So I think let's move off the field, as exciting as it is, and certainly as a South African at the moment, it's pretty much just sport, because we are participating in 2 World Cups. Well, we just won one of them, and the other is the Cricket World Cup, which again is probably your baseball, kind of.
Yep.
I'd say that's the closest comparison. Anyway, moving on from sport. So before we move on to Forecastr, which is the business that you're involved in, we need to learn a little bit about your background, just in building businesses. And I think one of the things I picked up is you built a pretty big consumer goods company. It sounds like it was basically from zero to over $40 million in annual revenue. That's a big business. quite keen to just spend a few minutes on that. You know, the backstory. What did this business do?
Yeah, this was interesting because I had come out of a tech startup and I went off and started another company with some friends while my wife had a hobby that she was working on. And it turned into a business that was far better than what I was kind of pursuing at the time. This became what's called Uppercase Living was the company. And I helped her raise some capital and we started growing that business. It grew very rapidly, like you said, from being in our basement to doing $40 million of sales a year. So that was an interesting pivot that I made. It was in the consumer product space. And honestly, it's a company that wouldn't exist without investors. We had some investors early stage come in and get us to the point where we could scale the business. It cash flowed pretty quickly, and so we were able to run that and not seek additional investment. A lot of lessons learned through that whole process. I ended up helping run that company for about 10 years. We sold it to a private equity group, and they had me stay on for 3 years as the CEO there. And yeah, like I said, a lot of lessons learned, but ultimately I did want to get back into kind of the tech startup space. And so after I took a little bit of a break after that, I ended up joining Carta, which is a company that serves a lot of startups, particularly in the US, helping them manage their cap tables.
So Jeff, is that business still going today, or is that something that is subsequently, was it a pandemic casualty, as so many businesses unfortunately were?
So yeah, unfortunate story here is that when we sold this company to the private equity group, they actually had 11 other companies. We were a smaller, one of their portfolio companies. And for the first year, it went great. And things were going well. We were growing and things were positive. Over the next 2 years, they started to pull capital from some of their other portfolio companies, including ours, to fund some of their other businesses that were struggling. And ultimately, this private equity group took 11 companies into bankruptcy. And I had left by then, but unfortunate ending for all of the companies that were part of that private equity group.
Story as old as time. Private equity buys a business and runs it into the ground. Man, it happens often. It's sad.
Yeah, it was not a fun 3 years, that's for sure, when they had me stay on. So
No, I can believe it. It's ongoing rolling of the dice, often lots of debt. I don't know if that was the case here, but that's typical as well. I mean, private equities investors are very well known for running retailers specifically into the ground. They're very, very, very skilled at that. Anyway, I think let's move on from there before I, get you saying too many awkward things about people you might know. No, I'm just kidding. So, Jeff, your background is very much in sales. And I wonder if that's actually part of why you find angel investing so interesting, because obviously these early stage, high growth companies, very sales focused. I mean, all companies obviously are sales focused, but hopefully you understand what I mean by that and agree with me that in that early stage, it's entirely about getting product to market as quickly and as broadly as possible. Is that part of why you like angel investing, or is that really just a coincidence?
I think there's a little bit of both. I think you do see that, especially early on, as an angel investor, you're betting on the founder, and that founder typically has to have some type of be able to build some confidence in you as an investor that they have a solution to fix a problem that's significant, but two, that they can sell it. And so a lot, early on, most of these companies are going to be founder-led sales, and you've got to have that confidence in the leader, the founder. So I think there are some correlations there that you do want to see a founder that knows how to sell their product. If they can't sell it, it's going to be hard for others to sell it as the solution. And so I think there are some definite ties there. I don't know that that's necessarily what I thought of when going into angel investing, but definitely some synergies.
Interesting. So I've seen your portfolio, or at least some of the names on LinkedIn. I don't know if that portfolio is perfectly up to date, but How do you manage in practice to keep track of so many angel investments? And dare I ask, to not have a scenario like that private equity company, where it kind of all falls down. Now, obviously, this is different. I imagine you have relatively smaller stakes across a broader range of investments. How do you think about this? And is it really a case of treating each one like a call option? In other words, if one or two of them do really well, it kind of makes up for everything. I mean, people also refer to that as power law. That's something that comes along often when you learn about venture capital, angel investing. And for those who haven't heard that term before, again, it just means, if there's a basket of 10 companies, you need two of them to do extremely well, and it will make up for the other 8, even if they fail to zero. If two of them do incredibly well, or even one of them does extremely well, you come out with a very interesting return. So, is that kind of the approach you take? And how do you keep track of all these different angel investments?
Yeah, great questions. First off, in terms of keeping track of them, I've got about 30 plus, maybe 35 different angel investments. And so keeping track of it, it's always nice to have these companies on Carta, because it's an easy way to issue the shares, and I'd be able to log in and see where all of my shares are. That's an easy way, but not all companies are using Carta, and so you have to keep track of them just in different folders and whatever. In terms of the power law, I would say that's definitely something definitely an aspect of angel investing. The thing I really love about angel investing, though, is that you're not necessarily tied to the restrictions of a venture capital fund as an investor. So if I see an opportunity that might not be a power law opportunity, maybe it's not going to be a 100x opportunity, as an angel investor, I can make a decision and say, okay, this might be a 5x return in a short time frame. That's very different than a venture capital firm, where they would look at, great, now we if this is only a 3-year time frame before this company gets acquired, that's not the most appealing investment for a venture capital firm. That could be a very appealing investment for me as an angel investor, because now I've got some more liquidity, returns faster, and I can then look to deploy that capital because it's my own money. So I think there's some differences between venture capital and the power law there and angel investing. At the same time, you do have to have kind of that power law dynamic if you're going to take some pretty risky bets, because there's going to be a lot of these companies that fail. I've already seen is it several? I mean, maybe 4 or 5, I guess, that have probably failed more or less. And something's got to make up for that, right? So you want to see a real winner that's like, that 10 to 50x your investment pay off. And that usually takes time, which, you kind of have to be patient as well.
The way that venture capital world works in the US is so different to how it is in so many other countries. And unfortunately in South Africa as well. We just don't have that sort of cap table culture, for want of a better description, where there can be these rounds upon rounds of investment, and people can actually access money to innovate. And that's part of why the US economy is as exciting as it is, in my opinion. And I mean, is it true to say that in the US, failing at a startup, it's not, your name is not mud thereafter. Obviously it's not ideal, but it's kind of part of the process, whereas I think in South Africa and in a lot of countries, you really get one shot to go out there, raise money, have an idea. If that one goes wrong, that's pretty much it.
Yeah, I think there's a very different mentality in the US in the venture capital space. I look at the founder of Forecastr, for example, Stephen Plappert. His first company, he took it through Techstars, and he raised some capital. It ultimately didn't end up panning out, and he now had the experience as a founder and learned a ton. I mean, if you ask Stephen or any founder that's been through it, they have learned so much on that first startup, and there's so much value in that. And I think that's what venture capital firms see, and why a lot of times the venture capital firms will look at the founder and say, do they have experience? Have they been through this before? Have they raised capital? Even if the venture failed, that experience becomes extremely valuable. So I think there is that mentality that, second time, third time, multi-time founders have an advantage. Your first go, you learn so much, and that doesn't mean that you're necessarily going to fail, but that's part of the game as well. I mean, obviously, as an investor, you don't want to see enterprises fail, but you are kind of betting on good founders, and the founders, you're kind of betting on them to be able to know when to pivot. There's great stories of founders that failed, and the way that they approach things with their investors is a real positive, and investors will come back and say, we love working with this founder. This particular one didn't work, but we think the next one has a good shot. So I think there definitely is a different mentality.
Yeah, that's part of why that ecosystem works, and it's very special. I think it's a function of the amount of liquidity in the US market. Maybe, let me ask you this. In terms of macroeconomics, and that's something I follow a lot, and follow a lot of listed companies. I mean, interest rates obviously a lot higher than they have been. Yields are a lot higher than they have been recently. Have you seen that have an impact on the angel space in terms of availability of investment, liquidity, that kind of thing? Or are things kind of carrying on as they were? Obviously, the pandemic was like peak madness in terms of money was literally free. So I would imagine it's come down since then. It's keen to get your views sort of from on the ground.
Yeah, for sure. It's definitely had an impact. You've seen investments slow because interest rates are higher. I mean, especially in the venture capital space and in the later stage investing. So you've seen the macroeconomics definitely impact investing at all levels. I will say that the earlier stage investments have probably been less susceptible to some of the macroeconomic trends. And, with that said, you're also looking at a 10-year time horizon typically on an early stage investment. And just because you're investing now doesn't necessarily, the IPO market or other things could be very different, 7 to 10 years out. And so I think investors are in general more willing to, take those risks earlier on. Whereas if I'm investing in a company that is later stage and the IPO markets have kind of dried up, that impacts my willingness to kind of go in on something like that. So I think that has definitely impacted things. One of the other impacts you do see is that a lot of angel investors, they are tied to the capital markets in general. And so if liquidity is drying up and you're waiting for IPO exits or different things like that, then that can impact the available funds. At the same time, acquisitions don't necessarily always slow down in these times. They can pick up. And so if you do have liquidity events through that, then, a lot of times angel investors will see this as a good time to invest early stage and to redeploy some of that capital. So it's an interesting game. And again, like I said, I don't think the earlier stage investing has been impacted as much as later stage right now in this environment.
A lot of it comes down to the components of that valuation, right? Very early, it's all about the entrepreneur and an idea and a total addressable market and an eventual conversion rate and a whole lot of assumptions, all of which will be wrong. But there's this kind of direction of, okay, where will this end up? Whereas obviously later on, it's more about the actual cash flows that are happening there and then. And I think at that point, there's also a game of, are we exiting in 3-4 years' time? And then to your point, you have much more visibility on what the IPO market looks like. So if the IPO market is not hot at all, then, it's much harder to justify those kind of late stage investments, whereas early stage keeps coming through. I hadn't actually thought about that before this chat, and that's quite interesting. So that's quite nice to hear that on the ground. I can understand from a financial perspective why that's probably happening. So thank you. That makes a lot of sense. I want to move on to a company in your list of angel investments that caught my eye, just because I think it's interesting. And, when it comes to angel and venture capital and everything else, people always think it's only tech. And often it is only tech, to be honest with you. It's a typical sort of as a service company, as you know. You've got a snowboard company in your list of angel investments. I guess I just thought that was really interesting. And I guess the point is, anything can be fast growing. It doesn't have to just be a tech platform. So do you actively look for things that are not just tech, or was this kind of a by accident?
Yeah, part of it is, I knew the founder. I know the founder. They're actually raising another round right now. It's called Kemper Snowboards. And really cool brand, and kind of resurrected an old school snowboard brand. One of the perks of that investment was I actually got a snowboard, and so there's an immediate return on investment. Not that that's what you're looking for, but consumer products in general are tough to raise capital for. You kind of have to have this established brand or something that's going to really propel sales, because it doesn't have that natural recurring revenue stream built in typically. So consumer products are hard. With that said, angel investors, again, are very different from a venture capital firm, where I would be okay if I get into a consumer products company and they double my money in 1 year, or they do a 3 to 5x return in 5 years. That's still a good win for me as an angel investor. If you're playing strictly the power law, that's an at bat that you just gave up, basically, right? So that's why you do see a lot of the VCs. They do have a thesis that's very recurring revenue driven, and there's wisdom in that, because that's where you can drive huge opportunities. Consumer products, yes, they can be huge opportunities if you get in on the right ones, but it takes a ton of capital, a lot of inventory. There's different dynamics behind direct-to-consumer companies, and they're just not as appealing to most venture capital firms in general, or venture investors. So that's kind of the dynamic there. I've invested in other consumer product companies as well, but again, they're kind of the exception to the rule, especially if you're looking at kind of the power law of huge potential companies. So that's kind of my take on it anyway.
Yeah, very nice. I enjoyed that. Okay, so let's move on to Forecastr. There are so many ways that you could be spending your time, and Forecastr clearly excites you and interests you because that seems to be where you spend the bulk of your time. I don't know if it's correct to call that your day job, but it kind of sounds like it is. Why is that? Why is Forecastr the one that you are so involved in?
A great question. So one of the things that I got when I was working at Carta, I joined fairly early. They had about 200 employees or so, and saw this company that was focused on selling into startup companies and helping them manage their cap tables, taking that out of spreadsheets and into software. I saw the playbook there, and Carta went from 200 employees over a 4.5 year period to about 1,800 employees, an $8 billion valuation at the time I left. And, I saw how this playbook worked. It was actually when I was at Carta that I met the founders of Forecastr. And the thing that was really interesting was they were doing something very similar to what Carta was doing in the cap table space with financial models. So two areas that founders typically struggle with are managing their equity and figuring out their financial model. Most founders, that's not a core competency, and they struggle with that. So Forecastr has made it so financial modeling is easy for founders. We've taken that out of spreadsheets and into a software platform that's easier for founders to use. This becomes helpful for the founders because now they can tell the financial story behind their company, which is really powerful. If they're seeking investment, they have to know the financial story of their company and how the company makes money. This became really apparent, and as I started talking to the founders, they eventually asked me, they said, we're getting some real traction on our partnership side. We need somebody to come in and run that. Would you have any interest? And I saw so many similarities with Carta that it became a no-brainer. So I joined this company very early on, and we continue to grow the company. It's been a fun company to be a part of. Puts me right in the middle of the startup ecosystem, working with VCs and founders. But there's a tremendous potential here with Forecastr. So very excited about that.
Yeah, it's quite interesting. So I always, whenever I meet people and they do interesting things, I always think of it like a Venn diagram. What they are doing now is always the intersection of different skills and experiences come together. That's certainly been my experience with the Finance Ghost, with my involvement with bizval, with almost everything I'm involved in. At the end of the day, your whole life is a set of experiences and skills, and you sit at the middle of those. And if you can figure out that intersection, I think that's true happiness in a career. That's when you get to build something really cool. It's when you're kind of sitting on the side of that and you're literally just earning a salary, not really doing something meaningful to you. That's the other world. That's the world that so many leave behind to go and become founders. And I think for you, the center of your Venn diagram is exactly as you've just described it now. And given you've done so many angel investments and, you've exited your own company, you've been on the wrong end of private equity and seen what happens there, it puts you in a really good position, I guess, to understand how to make that link. Because when I looked at Forecastr, the thing that really stuck out to me, which you've touched on straight away, unsurprisingly, is kind of linking the power of financial information to actually raising capital. So it's not a compliance thing. This is not accounting software designed to make sure that your taxes are correct. This is stuff to actually help you raise money, have a conversation with a founder and show, or an investor rather, and show your numbers, right?
Correct. Yeah, and the interesting thing is that most investors, they speak a different language than founders. They speak the language of finance. So when they start throwing out terms like ROI and, your ARR and MRR, churn rates, stuff like that, this is a different language for most investors that are running a company, right? But founders have to understand the language of finance, and they have to talk the language of finance when they're talking to investors, because that's what's going to resonate. So Forecastr helps the founders tell their story in that language that investors understand and want to know about, how this company makes money. So yeah, it's very directly correlated with raising capital, but also, as founders figure out how to use their financial model, they end up being better founders because they can start to make strategic decisions based on, the economics of the business. So it becomes a very powerful tool for entrepreneurs in general.
So you really touched on this a little bit in terms of tips, indirectly for people trying to raise money as founders. Speak the language of finance, I think, is a fantastic tip. Any others? What's your, as we bring this podcast to a close, the time's gone very quickly, which is always the sign of a great show. What is your best tip for a founder looking to raise capital? What would you say is the difference between success and failure? I know it's difficult to come down to just one.
Yeah, that is hard to come down to one. One, I do caution all of the companies that I work with is to make sure you have a good startup attorney. So your startup attorney is experienced. They know, how to structure around, what to look for, what's normal, what's not. Having that person on your side is very valuable for you, but it's also valuable for your investors, because an inexperienced attorney is going to cost them money, because they're going to have to go back and forth negotiating points that you really shouldn't have to negotiate. And so having an experienced startup attorney is beneficial for you as a founder and for the investors on the other side. So keep that in mind. And then the other thing that I just hit on briefly is, as a founder, you have to know your customers. Go out and talk to your customers, become passionate about customer experience and what the customer's pain points are, and make sure you're solving those pain points. That's the sign of a good founder that will go out there and are on the front line talking to customers. So those are a couple things that I've seen, good companies do.
Really, really interesting. And again, I'll comment there that it just shows how different the US ecosystem is to a lot of other countries, because, to your point, one of the most important things in raising money is getting the structuring right. And there are a lot of sort of common do's and don'ts in how to structure those different rounds, what the different investor rights are at different levels in the shareholder or the cap table. Again, in a country like South Africa, which you might find interesting, like that advice would never come up. I can tell you now, if you went and spoke to 100 South African investors, they would never say, well, first and foremost, make sure you have a good startup lawyer. So, and that's just because the deals here are a lot more bespoke. There's not as many hard and fast rules. We don't have this kind of deep understanding of a Series A, Series B, Series C. We learn this stuff by reading about it overseas, and there are examples in South Africa, of course there are, but it's not that common. So you'd struggle to probably find a really good startup lawyer here. I mean, they are here, but there's a handful of them. who have done a proper amount of deals of this nature. So for me, it just shows the level of the ecosystem in the US and how it drives innovation. In case it's not obvious, there should be some jealousy coming through in my voice here, because I think it's fantastic. And it's a big part of why the US economy is the powerhouse that it is. I truly wish for South Africa that we could have, anything close to the level of venture capital ecosystem that you have there. It's a real blessing, truly.
Well, honestly, it starts with what you're doing. It's the education, and you'll see as angel investors get more and more familiar with how investments do and how they work, you're going to see those things pop up where they want good startup attorneys because they're going to structure them right. And the angel investors are going to realize that if they go in and they're too predatory at the front end, they're going to kind of kill their own deals or shoot themselves in the foot because they're not going to be able to raise additional rounds of capital when they need it. And so they're limiting the growth of those opportunities. And those are all things that every startup ecosystem from the ground up has to go through and learn and build on top of. So yeah, that's very insightful, and appreciate you sharing that with me.
Yeah, thanks, Jeff. I appreciate all the insights as well. I think we're out of time, so I just wanted to say thank you so much for that time. In terms of Forecastr, maybe just a last question. International, is that the focus? Is it very much US clients? Do you have clients all around the world? And for those who do want to learn more about the tool, where should they find it?
Yeah, you can always follow me on LinkedIn. So go to Jeff Erickson. I'm with Forecastr. Forecastr is FORECASTR.co. And you can always go there. Actually, if you'll mention that you came through bizval, Forecastr will give you a free demo and give you a discount as well. But yes, it's very international. Nice thing about financial modeling is that it doesn't matter what currency or what the regulations are. You can build it all into the model, and it still becomes a very valuable tool, regardless of any of that stuff. So yeah, find us at forecastr.co, and would love to run you through a demo if it sounds like it'd be something helpful.
Fantastic, Jeff. Thank you so very much. And last comment from me. With Forecastr, just the spelling, of course, it's missing a vowel, right? Because it just can't possibly be a startup if it has all its vowels. It's like the number one sign of a startup versus a mature company. Can't have too many vowels or capital letters. We went the non-capital letter route, but you dropped a vowel. So there we have it.
Gotcha.
Anyway, Jeff, thank you so much for your time, and all the best with everything you're busy with. And thank you for sharing your insights with the bizval audience.
Well, thank you so much. Thanks for having me. Bye.